All right, welcome back to Module 4 of the Investment Rental Property course. This module will cover quick analysis of your rental properties. So we've been talking a lot about the deal spotter system. In the previous module, we talked about lead generation, where to find distressed homeowners, how to find deals, and how to generate those leads. You're going to take that information and reach out to the homeowners to see if they're even interested in selling you their property. Don't waste your time on the ones that say no. That filter is there for a reason. Only the ones that make it through that filter, that tell you yes, they're interested in selling, are you going to spend time on in section 2. We're going after the low-hanging fruit. The deal spotter system is designed to streamline your process and save you time. Don't waste your time on chasing after leads where the homeowner has told you out of the gate that they're not interested. So focusing on step 2 of the deal spotter system, we're going to talk about how to analyze those properties that the homeowners have told you that there is interest in selling their property to you. So let's go ahead and dive in. Remember that rule number 1 about investing is do not invest emotionally. It's all about the numbers, and quick analysis is where we let the numbers speak for themselves. Remember that as an investment property, you are not buying or renovating a house for you to live in. This is not about what you would want. This is about what is going to make you money, and the numbers tell the story. So as we're going through quick analysis, we need to talk about the numbers that you're going to be using and how to use those numbers to calculate a purchase price and a rent price that's going to make you money. So we're going to talk about a few terms. We're going to talk about the values associated with those terms and how to calculate your quick analysis. Now, gross rent is the amount of money that your tenant pays you. So if you advertise and have leased out your property for $1,200 a month, your gross rent is $1,200. Now, the only way to calculate a market competitive gross rent is by using rent comps. Now, rent comps is short for rent comparables. These are comparable properties to the subject property you're looking at. So a similar build style, you want to compare Ramblers to Ramblers. You want to compare condos to condos. You want similar bedrooms and bathrooms. So if your property has 2 bedrooms and 1 bathroom, you don't want to be looking at and comparing to properties that have 4 bedrooms and 3 bathrooms. That won't be a comparable. It needs to be the same. So if you have 2 bedrooms, you're looking at other 2-bedroom units and what they rent for. You're also going to want to focus in the same geographic area. I've talked before about imaginary lines. If there's a major interstate or a major thoroughfare in your area, usually those are imaginary lines that will change the real estate cost based on what side of that road you're on. So you want to pay attention to that. You want to stay as close to your subject property as possible while you're pulling these rent comps. Now, there's a few resources out there to find accurate rent comps. My favorite is just using a property manager. These property managers have tools where they can see what your property should rent for based on its area, its location, and its size. Another amazing tool is the internet. You can use sites like Rent-A-Meter, Ziply, Zillow. These are sites that have engines that find comps for you and give you a recommendation on what you should be paying or charging for rent. Always account for 8 to 10% vacancy as you're running your numbers. I know it would be ideal if we could count on our rental property being full 100% of the time, but that's just not realistic. So always account for that 8 to 10% vacancy as you're running your numbers. Now we're going to take our gross rent minus that vacancy variance, and that will give us our effective gross income. Now we're going to use that effective gross income number to calculate something called NOI. Now NOI stands for net operating income, and the equation is simple. Your effective gross income minus your expenses is your net operating income. Now it's important to note that NOI does not include debt service, as this may vary based on your strategy. So when we're talking about expenses here, we're only talking about things like utilities, things like taxes and insurance and maintenance. We're going to take our effective gross income minus our expenses, not including debt service, and that equals our net operating income. Now, debt service refers to the cost of your property debt. The easiest way to think of this is like a mortgage payment. So your NOI does not include your mortgage payment. Now let's talk about how to use those numbers that we just calculated to find out what our cash flow is going to be. Cash flow refers to your monthly profit on a buy and hold investment. This is calculated as follows. Your cash flow equals your NOI minus your debt service. Remember that cash flow is king. Smart investors use all of their investing strategies to directly or indirectly support their acquisition of cash flowing assets. Okay, now you want to make sure that you remember that there's going to be an initial investment. I see a lot of amateur investors make this mistake. When they're running their numbers, they're only calculating an ongoing monthly model, and they forget about the initial investment that's needed when you purchase investment rental real estate. Now, usually there's going to be a down payment, whether you're getting traditional financing like a mortgage or you're using creative financing strategies. There's usually a down payment that you're going to have to come up with. Don't forget to calculate that into your initial investment costs. Also, remember carrying costs. Your pre-occupancy carrying costs are going to be those costs that are incurred for holding the property before you actually get a tenant in it. A lot of investment rental properties don't come with tenants, which means that you're going to have a month or two where you've got to market and interview potential renters to put into that property, and you're going to have to pay that mortgage payment along the way. So make sure you calculate 2 or 3 months of mortgage payments while you're trying to get a tenant in there. Remember also your buyer's closing costs. Your title companies and your real estate attorneys are going to charge you a fee for their services, and that's just fine. Pay your professionals well, but remember to budget that money. Make sure you have those costs listed in your initial investment so that you don't miss anything and end up being upside down on a property. One of the last things to not forget is your initial repairs. Every now and then you've got to put new carpet in, you've got to splash some paint on the walls just to get the property up to par to be able to rent it out on the open market. There's a cost associated with that, and you don't want to leave that on the table. So make sure that you're calculating your initial repairs as well. If you add all of these things together, that'll calculate your initial investment, which will make you aware of what you need to have available upon closing this property. All right, so the question now is, how do we factor our initial investment into the ROI of the property? Well, usually I try to make sure that I'm at least getting enough discount on a property to cover my initial investment, which means that I'm not upside down on the equity of the property when I'm going into the monthly ongoing model of collecting cash flow. So for example, if a property has a market value of $200,000 and my initial investment is going to be $20,000, I want to make sure that I purchase this property for $180,000 or less to cover my initial investment and not put me upside down. Then once we've purchased the property and we make sure that we're not upside down on equity, then you can start looking at that monthly ongoing model and calculating the income that's going to be coming from rents. Let's go in and talk about a few rules of thumb as we start going down the path of analyzing this property. Normal return for most properties are about 5 to 7% on that initial investment. So if your initial investment is $20,000, you're looking for 5 to 7% of annual cash flow of that. That means you should try to hit more like a 10%, and if we get close, you're spot on. So remember that we're in quick analysis still. We're just running the numbers to make sure that this property is worth our time, and if it is, we're gonna push further through the process. Now, you have to calculate a decent cushion for repairs and vacancies, and I would say a 20% cushion is reliable. Remember that higher interest rate loans will kill your business. But loans are also useful to grow your business, so it's a balance. You have to use debt to be able to acquire assets, but you want to make sure that your interest rates are in check so that it's not eating up all of your cash flow. Remember your monthly recurring costs, like insurance, HOA, and management. If you don't remember to calculate those costs up front and build them into your model, they could potentially take what you think is a cash flowing property and make it something that you end up forking money out for every single month. The numbers are important. And finally, as a good rule of thumb, remember the 50% rule. If your quick analysis says that you should be making, for example, $400 a month on a rental property, remember that there's often soft costs that pop up that you had no way of calculating or guessing when you were doing your quick analysis. Things like random maintenance on the properties, things like disposal services, things like extra utilities one month. Oftentimes that eats up a little bit of that cash flow. So as a good rule of thumb, only count on about half of that cash flow making it into your pocket. Now, for the sake of quick analysis, which is just getting a quick idea as to whether or not this property is worth pursuing to the next steps of the Deal Spotter system, I like to use the 1% rule. If your gross monthly rent, which is your rent before expenses, equals at least 1% of the purchase price, then it's worth considering. For example, if your gross monthly rent is $1,700, your purchase price should be at or below $170,000. Now, a few things to keep in mind. This is not a perfect way to analyze a property. This is just letting you know if it's worth continuing through that Deal Spotter system into making an offer and doing your long analysis and eventually potentially closing on this property and purchasing it as an investment. It's not a real way to decide, only a quick look to see if it's worth digging deeper. Now that wraps up our quick analysis module. This has been module 4. I'm looking forward to seeing you in the next module. We'll see you then. Thanks for watching. If you enjoyed this content, please consider subscribing. If you want to learn even more about this topic, hop on a free one-on-one strategy call with us. All you have to do is visit flippin.education to book your call today. That's flippin.education. Hope to see you there. And until next time, we'll see you on the flip side.